The ETF industry has been in the business of disrupting and improving investor outcomes for the last 30 years. ETF issuers, the product providers, are on the front line of that disruption. Here, we get to hear their stories and learn what it takes to be a disruptor in the ETF marketplace. This is ETF Wavemakers. Welcome to ETF Wavemakers. I am Cinthia Murphy, Head of Research for the ETF think tank. And today we're talking to the one and only Phil Bak, CEO of Armada ETFs. Hey, Phil.
Hey, how are you? Great to be on.
I'm very excited to talk to you today because, this series is all about the ETF Wavemakers, the ones disrupting, innovating, breaking new ground, and you have to be the poster child for that. I think, I was thinking about preparing for this conversation today of all the many years we've ran into each other in events and many things. And I have always never known what's going to come out of your mouth. What are you up to now? It's always something new, innovative, creative, sometimes sounds even a little bit crazy. So I loved that there's always a surprise element when it comes to you and the ETF space. And I never know, is it because you are just this disruptor at heart and a visionary, or is it because you're like an Olympic level risk taker? So which is it? What drives you to constantly be going where the puck is going or where nobody dares to go?
So, it's fine. I don't think I'm a risk taker at heart. A calculated risk taker. So, in this industry, everyone who grows up in finance, everyone who starts their career and thinks critically about risk and portfolio and really any side of the business, you spend a lot of time thinking about, well, there are no certainties in this business, right? Certainly in the investing side, what you can do and what you must do for yourself on behalf of your clients and any trading strategy and any allocations, you have to tilt the odds in your favor. But, at the end of the day, the market does what the market does. The business, there's so much that we do that is really about probabilities, not guarantees, not certainties, hopefully not possibilities, but probabilities. And I view the entrepreneurial side of the business and the business side of the business very similar to the way I view the market side of the business, where if you can tilt the odds in your favor, even slightly, but if you get that over that, 51% chance, of a positive return, then risks are worth taking. And, the problem is when you do these things on a portfolio level, you do them over a long enough time, frame, the sample size is big enough that eventually, you have some bad luck, some good luck, and things kind of work out in the end. As an entrepreneur, your sample size is one. It's only your career. It's only your life. And, I've been fortunate. I've had more than one opportunity and who knows what'll happen in the future, but it's very hard to take that approach. If you have a 60% chance of a positive outcome, that means a 40% chance of failure. And how many of us can survive a 40% chance of failure in a major career move? I'm no better off than anyone else when it comes to that. So, it's really a question of saying, okay, maybe I've taken that bet and maybe the 40% came up. Okay, that's fine. That happens, right? And maybe I took it again and the 40%. Do I get up the third time? Do I still take those odds, those 60% odds, right? Do I still, if I think the odds are in my favor, am I still willing to have the courage of conviction to say the odds are on my side, even though there are no guarantees and it might not be, the safe career path? Am I willing to take those odds and see things through? And so far I have, as you can see, I've lost a lot of hair in the process. I've gotten some grays now in the beard. I've aged. Entrepreneurship is not for the faint of heart. It is hard. It's harder than I expected. It's harder than I thought. It's not always fun, but a lot of times it is too. And the rewards are tremendous. So, for me, it's really more about the discipline of being willing and able to take those opportunities where the odds say that you should.
So is this, because I was going to ask, do you find just entrepreneurship and specifically ETF entrepreneurship rewarding? And, to that, is this really the core question here is it about conviction? You have so much conviction in what you're doing that it is worth that 40% failure risk, just to use a random number? Or is it about just being comfortable with the odds and it's all about finding solace in numbers?
So, that I don't know. That's a very good question, and probably one that I'll be thinking about now for a few days. I think the ETF industry rewards success. The rich tend to get richer. The bigger funds tend to get bigger. It's very hard to break through. There's a lot of noise. There's a lot of saturation. It's very hard to break through. And the ETF industry tends to work at scale. The more the scale, it's easier to scale a product than it is to get a product to critical mass. It's easier, and it's not just on the fund side. It's in a number of the areas of the tangential areas of the ETF industry. So the ETF industry is not really built for someone like me the way I've approached it. The ETF industry is wonderful for a firm like BlackRock or Vanguard that has, I mean, BlackRock, to their credit, they saw that opportunity and made a huge investment in iShares from BGI. But once you have a market leader position in a category or an asset class, to drive that story and to scale that is a lot easier than trying to break through. So it is difficult, but it is also achievable. And even though it doesn't happen often, it does happen often enough that people like me keep coming back for more. And while it is difficult, the rewards are tremendous. The rewards are huge. This is a phenomenal business post critical mass, right? You have, assuming, your product does what it's supposed to do and your clients are happy, it's easier to retain assets than it is to bring them in, which means that you can have a recurring, annuity stream and income that is significant. The scalability, like I said, of these funds is quite high. So, there is, the fat tail, the positive outcome of getting, super wealthy from doing one of these things is a very real possibility. Although not a probability, but it's very, very difficult. And, like I said, there is a lot of saturation. There's a lot of competition. There's not a lot of protection for intellectual properties. There's a lot of people that, say, or maybe they feel in their hearts, they're kind of rooting for startups and entrepreneurs, but really the odds are very, very tilted in favor of the bigger corporations in a number of different ways, in a number of different places, to the point where I think, we're almost, like bumping up against some antitrust laws in some instances in this industry. So it's hard, but look, that's, this is the game that I signed up for, and any other ETF entrepreneur, if they didn't know any of that, that's on them. These are the rules of the road. Everyone knows that coming in. So, you can't, step up to the plate in Major League Baseball and then complain that pitchers are throwing 95 miles an hour. You have to know that, hey, I'm signing up for this thing and I'm willing to try to hit a 95 mile per hour fastball in order to be successful. So, you can't kid yourself. You have to be ready for a very tough fight. You have to be a certain type of person, I think, that's willing to, potentially fail publicly. Everyone can see your assets. They're all out there. Everyone can see the trading that does or does not happen in your funds. A lot of people, you would think would be rooting for you or on your side, but then, they'll say, oh, we only work with a certain size firm. We only work with certain corporations. We only work with, companies that are already working with us in other areas. And you hear these different things that, really, really hurt. And, that are very, very difficult to process and to understand when you think people are, when you have a product that you think is better for the investor and you make that case, and then the investor concedes such, they concede that this is in fact the best fund for this allocation that I have, but they don't allocate anyway because of these other, biases towards bigger companies or, whatever deals or, whatever is in place with different platforms and different allocators to other asset managers. It gets very, very difficult. But that's the game, right? That's the game. And anyone who wants to play it needs to be aware of that. You need to be honest with yourself. You need to say, all right, I am, the odds are going to be stacked against me, and I'm willing to compete in an environment where the odds are stacked against me.
Yeah, the gift wrapping, right? All the shiny ribbons and stuff. And I've always wondered if that is one of the biggest challenges of the ETF space. We all talk about distribution as the biggest challenge, assets, beget assets, all that stuff, but it really comes down to the IP. And we see this all the time, like the smaller firms, the new firms, that they're really breaking new ground with some really interesting stuff. But then a BlackRock comes in and takes that IP and launches it cheaper, and there goes, a really viable idea. A lot of times that happens. Is that, you think, like one of the biggest challenges here is that you can't protect that IP? The ETF industry is all about transparency. So you got to protect yourself in other ways, either by really finding strong partnerships, collaborations, which are also key because there's so many moving parts of the ETF space, as we know. So you got to partner up with the right people.
It's very disappointing that there are people who will say that, we don't want to do business with China, or we're going to sanction other governments or look down upon other governments because they don't respect IP laws, and they, there's copyright infringement and patent. And for those issues, we as America, as Americans, as the business community, can look down on other countries and venues that don't respect IP laws. And then when it happens right here in front of everybody out in the open, people forgive it, and they don't mind. And I think it's really uncool. There's nothing, taking somebody else's fund idea and replicating it and copying it because you're a bigger company and you can, and coming out with that fund. Okay, it'll bring you a few assets, but I mean, for me, that's not how I want to make my money. I just don't find that to be intellectually challenging. I don't think that's a rewarding. I mean, that's just not what I do, right? And there are firms that do it, and you would think that some of their clients, some of the allocators, some of the gatekeepers, some of the people who are in a position to, punish or reward that behavior, you would hope that they would punish that behavior and not reward it, but they don't. They don't care. They don't give a shit, and that's been made clear in the ETF industry. So again, this is the game that we've chosen to compete in. What you have to do is you have to find those pockets of the market that are protectable, and there are some that are protectable. Look, active management, non-disclosed active, certainly, but there are active strategies that are protectable. Cult of personality type sales practices, like, we've seen with ARK, with others, thought leadership, that kind of thing, that's protectable, right? Nobody can replicate a personality. Nobody can replicate the ideas that are coming out of a company or a person. There are things that you can do as an independent that can't ever be copied, right? BlackRock might try to create another Phil Bak. I don't think they can. And
no one can.
I mean, that may or may not serve them well. They may not want that. They probably don't. But should they ever decide that that's something they want, then that's not something they can do. So that's one of the reasons why I've chosen, my whole career, I was a behind the scenes guy. Nobody knew who I was except for the people I worked directly with. And I was 2 years into Exponential, into my first ETF startup, when I realized that I needed to, I needed to be authentic. I needed to connect with people. I don't need everyone in the industry to think I'm okay. If I was the CEO of Vanguard, maybe I would, but I'm not. I need a very small percentage to say, I like him, I want to do business with him. And in order to find those people, I had to be transparent, authentic, build in public, do all the things that I've come to do. And it's all new to me. I mean, I never posted on social media, up until, I guess, 2018 or so, maybe 17. I had a long time Twitter account. I was just following like baseball writers and comedians, just like, once in a while check in and
entertaining yourself online. Yes.
Yeah, no, it was never what I did. And I've since, and now it's the other end of the spectrum where you might say I'm addicted to it. It's terrible. Yeah. But this was, very deliberate from my point of view, where, I said, okay, why would anyone work with, at the time, Exponential, now Armada, but why wouldn't Allocator work with us when they can work with BlackRock? What can I do that BlackRock can't? Well, here's what I could do. I could say, I think the Fed is making a huge mistake with their current policy. I can say that. If I worked at BlackRock, I couldn't, right? I can say, I can share my opinions on the market. I could say, hey, I think we're due for a pullback here. I couldn't say that if I worked for a large asset manager. I couldn't just get on and say, oh, I'm bearish, at this point in time. But I could speak freely. I can speak myself. Now, that is, I talked about some of the disadvantages that startups and entrepreneurs have in this space. There are advantages too, and that's one of them. So, it is with that in mind that I said, okay, I need to do those things that I can do better than them. I can be faster. I can be more outspoken. I can be more myself, more authentic. And that's not something that they can replicate. That's not something they can ever take from me.
Well, what I think, one of the things that you do stand out to your point earlier about, this is a noisy marketplace. There's so much going on, so many players, so many funds. You have to stand out somehow. And hopefully that's through unique expertise that investors benefit from. But I think too is the transparency. And I think what's really special about the way you've tackled this beast of cutting through the noise is that you're just as quick to share the success stories as you are the failures. And what I think is so rewarding about that, to be on the other side of that, is that there's so many lessons there that everybody learns from, whether you're somebody looking to enter the ETF space, whether you are a provider, whether you're an ETF investor or an advisor, or whoever you are, like lessons are lessons. And I think that honesty really stands out. We love to project success. It's not everybody who's open to going and say, hey, this really did not work out, and here's what I got from this, other than just sheer pain. And so, to go on the painful spots, or, I'm curious if when you look back and all your experiences, and we'll talk about Armada in a minute, what were some of these lessons that were kind of pivotal for you in this path of determining where do you go next, or do you stay on this path, or do you know this is the right approach and the right strategy for you right now? What are some of these moments that stand out to you?
The best lessons come from failure. There's no question. When you fail, you learn, and I think there are two kinds of people. There are people that fail, that get very, gun shy after that. They fail, they're embarrassed, they don't want people to know, and they kind of shy away. And those are the people that will never, will never keep fighting, keep pushing, have the persistence to push through. Most startups go through a period where, where they struggle, where they struggle, they pivot, they got to find product market fit. And, this industry in particular is one where there is a compounding effect. When things are working, they work really well. But when they're not, it's very, very difficult to get things going. It's kind of like starting a fire. It's like hard to get it going. Once you have a fire going, you can throw logs on and blow things up and scale them up and keep them going. But it's very hard to get going. And we've had plenty of failures. And there's a concept going on now in business and startups in particular of building in public. A lot of people talk about, we're going to build in public, and it sounds great in the beginning. And we're going to build in public. We're going to show our clients and our customers and our VCs and everyone else. We're going to show them what we're doing. We're going to take them behind the curtain. They're going to be invested in our success. They're going to watch us and follow our trials and tribulations. And it's a way to kind of build up more of a connection between the company and the people that they're trying to reach. But what often happens is when those companies, aren't having success, they don't want to build in public. All of a sudden, it's like, all right, let's keep things a little bit at arm's length. I don't, I just don't believe in that. I mean, for me, it's not about, an ego or trying to put on airs or present that we're better than we are. It is what it is. Look, it is what it is, and I've taken these risks, and I've taken these ideas, and I've put them out there, and if they work, they work. And if they don't, I think, hopefully our clients know that everything we've done has been in, best practices, best interest, because we believe in them. We would never launch a fund that we ourselves wouldn't invest in, that I wouldn't put my mother in or my grandmother in. Like, that's just not what we do. So, when we fail, we fail. There's no way around it, right? We're building in public. And if things don't go well, then anyone can see it. They can see our ADV, they can see our AUM. When we launched Exponential, we probably the one that I spent the most effort, really the one that I was most determined to distribute from a sales, was the reverse cap fund. And the market didn't take, the first couple of years, it just didn't happen. Talk about probabilities versus, like we talked about before, equal weight tends to outperform market cap weighting. Historically, going back as far back as we had data, it was about a 2/3 batting, right? It's about 65% of the time. And it happened to be the first 3 years of reverse. So equal weight, when equal weight outperforms market cap weight, reverse cap also outperforms equal weight. And that's what I was trying to do. Extrapolate that equal weight premium a little more so with reverse cap weight. Well, our luck, we launched it right into this huge FANG run, this technology run. We underperformed for a while. We couldn't really get the product distributed. And there was no hiding it. I mean, it was, anyone could see the assets, they could see what it was. And it was a huge blow. I mean, for me, like, I'm still recovering from it. It was, I really thought that I could single-handedly push that product through, and I couldn't. And, it was difficult, but, we find a way, and we ended up, our company, we didn't, we had another fund that was doing better. We did a lot of sub-advisory work and kind of I had a really great portfolio management team. Shout out to Charles and Eric and Chow and the rest of the team that very well. we said, all right, we've got this great team there's all these asset managers out there. We can, manage their taxes more efficiently, manage their rebalances. We'll use what we have here to make ends meet to keep this company going. And that was what we did. And it's the same thing now with Armada. We've got REIT focused funds, and we're looking at different ways. We've got now some new AI technology. We're looking at different ways and different things that we can do, because most of the time you launch a fund, it doesn't immediately rocket up to billions. You don't have revenue for a long time, and this is a very expensive game to play. So you gotta find ways to bring in revenue, and we'll do that. But you can't hide. You can't hide in this industry. They're not in ETFs, maybe in hedge funds, but not in ETFs.
Yeah, we typically estimate that you need to be able to support your fund at least 2 years, assuming zero organic growth. And if you can't do that, then think carefully about what you do next. So let's talk about Armada a little bit, and then I'm just going to throw this out there because now it's stuck in my head, and I'm just going to get out. Like, when you launch a fund, we see this all the time. It can be like the coolest idea, but the time for it is either ahead of its time, or the market environment is not for it. So I remember when the reverse cap fund came, and it was so cool. Nobody had ever done anything like it. So, is it ever worth, or how do you know if it's worth revisiting an old idea that maybe was just ahead of its time? Or do you never revisit an idea that didn't work initially and you go on to the next thing?
Timing is very, very difficult. And it's the same, with trading as with product development. The product development cycle is pretty long. So, usually you have a period where you're, back testing or refining, working on a strategy. Depending on your organization, there might be a long process of a committee approval or a board approval, or gathering the resources or whatever it is. Then you file. Then it's about 3 months, a little less than 3 months, but depending, it could be about 3 months until you get approval. Some funds, it could be even longer. Bitcoin, it could be a decade, right?
Mm-hmm.
So it's a long process, and you're trying to project, what the market cycle is, at the time that you start the fund. There are people that are always trying to kind of catch the current trend, and there's some people that are very good at it. It's not really what I do. Again, I think when we launched Reverse, one of the things about Reverse at the time, and Reverse itself, the way it's composed is very cyclical, but at the time it had a strong value bias because we're coming out of a momentum cycle, and Reverse is always counter-cyclical. It's a mean reversion play. I said, and this is back in, we started in 2017 with it. I said, well, we don't want to play for the growth tech cycle. We want to play for the next cycle. This has been already 8-9 years at the time of this kind of growth cycle. Let's build, if anything, value bias funds that we think are due for the next cycle to outperform. That was about 2017, and what happened was 5 straight years where the tech momentum cycle just continued to outperform. So we're completely wrong about that. It's very, very hard.
You were just 5 years ahead of your time. Last year, this would have been the star.
Yeah, that's right. That's right. So, you just don't know. Sometimes you get lucky, sometimes you don't. Some people maybe do time it. I think what we're doing now with REITs is also very, I think, very timely, because even though a lot of people are very bearish on, real estate, given where we are in the rate cycle, what I think a lot of people have missed is that within REITs, the subsector correlations are very low, and there are certain REIT subcategories that are significantly better positioned, in our view, than others. And when you look at VNQ, 65-70% of all REIT ETF assets are in VNQ. Market cap weight in REITs is significantly higher than it is in equities even. And the way those funds work is anything that's a REIT goes into it, and it gets weighted by a size of the REIT. Well, the definition of a REIT is ever expanding. And a REIT is, what it really is not necessarily real estate. What it really is a tax treatment. So the definition of REITs is like, expanding beyond pure real estate, and VNQ is that now. It's now a market cap weighted fund of anything that elected for the REIT tax structure. Most people that I talk to that own VNQ don't understand it. They think that they own real estate. A REIT is a REIT. They're all fungible, whatever. It's all real estate exposure, and that's what they own. But in reality, increasingly, they don't. They own something a little bit different. That's got a little bit different factor exposure. So, we feel like a dispersion of REIT returns, right? If office REITs truly implode, if Jim Chanos is correct about his data center short thesis, right? If rates maybe they've topped out, or maybe they continue. Either way, in every scenario, we see a coming dispersion of REIT markets, of geographies, of subsectors, of all these different elements that make up the REIT market, which means that there's an opportunity to give people a better, smarter exposure, better way to access REITs. And that's what we're trying to do. So, again, it's not necessarily timing it and saying, hey, we think everyone should pile into real estate at this moment in time. It's not that. It's more of, hey, is this a good time to offer people something, better, something differentiated and something better? And, again, a lot of what we do also is planting seeds that bear fruit years later. So when we talk about active funds, typically most investors want to see a track record, of, I'd say probably the median, the most people are going to want to see at least 3 years. So, I talked about, let's say, a 6-month on average product development timeline to get a fund out, to get a fund internally approved, to get it, structured the right way, to figure it out, then go through the registration process with the SEC. Let's call it 6 months in total, right? 3 years to gather a track record. You're talking about something that's, really commercially viable on a mass level 3.5 years later. What the world looks like in 3.5 years, I don't know what it's going to look like next week. So I wouldn't play that game of trying to time it, too tactically for what we do. I don't think that's necessarily such a great strategy, but there are people who are very good at it. There are people that are always on trend, and that's how they do product development. And I think if you can do it well, I think it is viable.
Yeah, no, what I love about that thought is the idea that you can innovate in many fronts, right? So it can be this long-term tool in a way that it isn't necessarily about finding a space that hasn't been explored. It's just about delivering access in a different way to something that may be really well trodden, like real estate and REITs, but you're rethinking the way to access that. And it can be like a short-term tactical thing. We see a lot of that in the thematic space, and this is hot now and you'll probably be cold in 3 days, but today is the story everybody wants to chase. So, from that perspective, Phil, like as you look at the market today, what are some of the ETF trends that you think are exciting or that you think are completely cringeworthy? What are you watching these days?
So, I go back to first principles, and I think, people have really, discounted this idea that asset management is commoditized, and people kind of discount the promise of alpha. Everyone's very skeptical these days. Market cap weighting has worked for so long. I don't think that's a permanent condition. I don't think it can be. I think, there's a point at which the market opens up for opportunities for alpha that, that just are going to be so blatant, and that people just aren't going to be taken advantage of, because so much of the money is now passive, derivative based. So I think there are real opportunities on the value side, on the active side. That's where we're focused. We're using AI, but not in the way that a lot of ETF issuers are, in a very different way, in a very quantitative way, where it's really machine learning more than AI. We've got very complex models through our partners at Arialgo to really understand what is driving REIT valuations, REIT trading, right? And what signals the market is responding to in different market environments, and what is the derivative of those signals that we can pull forward-looking indicators from. And we haven't launched those models in an ETF. We'll see, but we're trying to really understand how to use the new computing power that's now available to everybody to find edge in our world, which is REITs. I think the more everyone else is kind of looking at, hey, let's just it's all beta. Let's find new slices of beta, new areas. What's going to be the hot new tech thing that we could just package up 30 funds and throw Apple and Amazon in there, and I think there's a lot of people who've taken their eye off the ball. And I think the ball, what's important is really fundamentals, understanding, what's driving the market, understanding the companies and what's in them, and how to price them, and what the market's responding to, what the market may respond to in the future, and getting ahead of that so that you can manage assets the right way. Coming off of a 15-year cycle where the average return has been almost 15% with very little drawdown risk outside of COVID. I think people are kind of being a little too complacent, a little too dismissive of active management, of risk management, of the need for alpha. You know, when an advisor puts together an investment plan for their clients and they're way ahead of it, right? It's easy to be dismissive of alpha because, you know, whatever, everything's working. I know what I'm paying on fees. I can go low fee and it's fine. In an environment that we may enter into, I don't know, but if we do, that is more sideways or even down, I think that conversation is going to change very much. And like I said, you know, you're planting seeds today that are going to yield fruit a couple of years from now. Now is the time to plant seeds for products that are designed to do better risk management or better risk-adjusted returns, using some sort of edge, some sort of proprietary, you know, methodology or insight or something that other people can't replicate. So that's what we're focused on, and I think that's where the opportunity is.
Yeah, no, it's all about risk management in the end. So as a final thought, which it's hard to have with you because I think we could talk for hours. I love listening to the stories. But you know, just the idea of the ETF wrapper as this risk management tool, you know, with all of the comes and goings, all of the things you've done, all of the things you've seen, you know, everybody in this business, you know what everybody's up to. You've also, you know, you're transparent out there, but you've also watched people succeed and fail. Is the pain and suffering as well as the glory that comes with being in this ETF business, is it all worth it? Is the ETF wrapper really that special? Because it's not the only wrapper. You can invest in other things, as we know. Is it all really worth it to be in this ETF?
It's not. Save yourselves. It's horrible. It's horrible. The thing about ETFs are great for the investor. They truly are. They are great for the investor. They're low cost. You know, depending on the product, most products are going to, you know, not have internal cap gains. They're great from a tax efficiency standpoint. They're really easy to use, really easy to access. It's great. It's been great for the investing world. It's been great also for people like me and for entrepreneurs that want to launch funds. It's not such a you know, terribly high barrier to entry to get in. There is a high barrier, but not obscenely high, at least not to launch, right? To get to critical mass is another thing. So it's been great from that standpoint. You know, from a business standpoint, right? Having products that are less good for the client can be a lot more profitable, right? They're better for you and not necessarily better for the client. So, you know, you've got these, you know, interval funds and private funds. You've got, you know, obviously hedge funds, where people have a harder time getting their money in and out, where the money is more sticky, where you can charge a performance fee, where you can do different things that are far more profitable for the business side, for the fund. But it's frankly just not as good for the client. And, you know, so again, it's just not something that I'm very interested in doing, but, you know, for someone who's just a businessman, you know, if you're thinking about it from that standpoint, there are more profitable areas in finance to focus on.
Yeah, I guess it's about the reward of doing good for somebody else. You know, at the end of the day, maybe what goes around comes around. I don't know.
Yeah, and look, you know, like I said, it's a very hard business. You got to do it for the love, or don't, you know, if you love this, if you love, you know, the whole process and the whole, you know, if you love it, then do it. But if you don't, it's hard enough that, you know, it's going to be hard to stick with it.
Well, you guys heard it here first. Do it for the love. That's what it's all about. Phil, I cannot thank you enough. It's always a treat to connect with you. I'm so excited we had a chance to chat today. Thanks for coming on the show.
Thank you. Yeah, great to talk.
And everybody check out the rest of the series, and we will see you next time.